The regular question first-time buyers ask me is, what is the difference between a mortgage deposit and an exchange deposit? In this video, I'll answer that question. Let's go. Hi, my name's Alex Kerr. I'm a qualified mortgage broker and my passion is simplifying the mortgage process for first-time buyers. Let's get into the video. Let's start with a mortgage deposit. A mortgage deposit is the total amount of deposit you are putting in to buy your property. So for example, if you are buying a property for £200,000 and putting in a deposit of £30,000, this equals 15% of the property, then your mortgage deposit is 15%. It's the total of your deposit. This is also reflected in the loan to value of the mortgage product you are choosing, which will be an 85% loan to value product in this instance. This is because you are putting in 15% of the property's value yourself and borrowing 85% of the property's value from the mortgage lender. So let's have a look at an exchange deposit. When you purchase a property and you have obtained a mortgage offer and all of your searches are back from the solicitor and you are coming towards the latter stages of the process, your solicitor will ask for your exchange deposit. They may not physically call it an exchange deposit, as it all depends on how much you are putting in as a deposit. This is so you can exchange contracts with the person you are buying the property from, and the transaction therefore becomes legal and binding. However, an exchange deposit usually means that everyone within the process, which is referred to as the chain, whether you have a big chain or maybe you are chain free, means that everybody needs to put in a 10% exchange deposit, irrelevant of how much your total deposit is, which is known as your mortgage deposit. So you might be putting 20% in as your mortgage deposit, your total deposit, but you may only be asked for 10% of that deposit in order to exchange contracts. This is essentially everyone within the chain committing to that exchange deposit, and they are committing to the transaction itself. It's a bit like putting a deposit down on something like a car and then turning up a week later with the rest of the money to purchase the car and take it away. In this instance, it's the same process but with buying a property. You put your deposit in order to commit to buying the property, and if you pull out after that point, you lose your exchange deposit. This is what an exchange deposit has traditionally always been. However, you now have 95% mortgages available, meaning your mortgage deposit is 5%. So therefore you cannot put in 10% as a deposit. So what happens here? In this instance, your solicitor will receive agreement from everyone else within the chain that they are happy that your exchange deposit is 5%. This will then be agreed and in goes your deposit. Complications can sometimes happen when trying to understand this process because it's not obvious the difference between the mortgage deposit and the exchange deposit, especially if you are putting in a 5 or 10% deposit in anyway. The solicitor will just ask for your deposit because that will act as both your exchange deposit and your mortgage deposit. However, if you are putting in more than 10% as a deposit, this is when you may be asked for 10% of your deposit to exchange and the remainder before completion. However, the reality is that your solicitor might ask for all of the deposit just before you exchange contracts. However, should you pull out after exchanging contracts, anything over the 10% deposit you would get back. However, you would lose the exchange deposit. The most important thing you do is just to check with your solicitor or check on the contract, as this will have the finer details into what happens in the event that you pull out after exchange of contracts and how much of your deposit you would lose. As mentioned, traditionally this is 10% required for your exchange deposit, but as explained, permission is needed if it's a 5% deposit you are putting in, that this is acceptable, and should it be something completely different to this, it would be included within the contract. Personally, I think it's a good idea to try and exchange and complete on the same day, especially within the environment we are in at the moment. Normally what happens is you exchange and then complete a week later. In between exchange and completion, the mortgage lender would send the funds to your solicitor, who would then send those funds to your seller's solicitor. However, exchanging and completing on the same day means everything happens simultaneously, and there is no risk of anything going wrong between exchange and completion. Not that anything would go wrong, it's just that we are in a bit more of an unpredictable society with everything going on in the world, and there is always the first time for everything. So my preference would be to try and exchange and complete at the same time, and this is certainly a conversation I would be having with my solicitor. Today's question: were you asked to provide an exchange deposit? I would love to know. Mortgage warning. Please note, we do need to let you know that your home may be repossessed if you do not keep up with repayments on your mortgage. So thanks for watching today's video. I hope it's provided you with some useful tips. Please check out the show notes for a recap with access to any links discussed today. Please consider subscribing and ringing the bell to receive notifications on our latest videos. I've been Alex Kerr, providing the best tools and tips to first-time buyers. I'll see you in the next one.